The bulk of household debt in the UK is essentially made up of mortgages, and that accounts for about 80% of the total stock of debt. The other 20% is made up of unsecured debts, which is essentially comprised of credit cards, overdrafts, and increasingly car finance. So in recent years, what we've seen is this acceleration in the growth of unsecured debt, but we have seen that slowing in recent months. And if you look at the average in 2018, then unsecured debt grew by about 8% year on year, and that compared to about 10% the year earlier. Car finance has been one of those key drivers of unsecured debt, and we saw levels rising by about 20% year on year from 2014 to 2016, but that's more than halved for 2018. But what's really important to understand is that households are in a much better position to deal with any financial distress that's thrown their way than they have been in previous years. And so although debt levels have risen in recent years, our view is that what's really important is debt servicing, and that remains manageable for most households. So that's the good news. And actually, if you look at unsecured debt, 60% of it is held by households with above average incomes. So the majority of them have the financial assets to pay them off anyway. However, there are some concerns that if we saw a sudden shock in the economy and we saw a sudden deterioration in household balance sheets, then this could lead to some problems. According to the IFS, about 15% of the lowest income decile of households, so this is the least affluent 10% of households in the UK, they are in arrears on repayments. And an additional 10% of those spend more than a quarter of their income on unsecured debt repayments. What this means is that in total, around about a quarter of the lowest income households may be struggling with arrears and high debt repayments. But what we also found with our own proprietary research was that around 29% of the least affluent households showed some concern around repayment of credit card debts. That proportion fell though to 14% for the most affluent households. So while the least affluent households hold less debt than wealthier ones, they're more likely to have debts that are greater than the value of their financial assets. And what we found is that 35% of the lowest income decile have debts that exceed their financial assets, and that compares to 10% for the wealthiest. And so for this reason, lower income households are likely to struggle with further potential interest rate hikes in the near future, and also if there was any financial distress coming down the pipeline. We anticipate that the growth in consumer debt will fall on last year's levels, but this is predicated on the general outlook for the economy remaining fairly robust, but also consumer confidence to remain quite weak as consumers are worried about Brexit, lack of savings, and also levels of debt. So overall, while we believe that households' balance sheets are in a much stronger position than they were prior to the financial crisis, there will be a slackening in support in terms of spending because of less growth in the credit market. But it will also be the least affluent households that we're most worried about, just in case there is a major shock to the economy, for example, in the event of a hard Brexit.